In this video, we're going to talk about a common measure of profitability called EPS, or earnings per share. From our previous videos, you know that there are different types of shares. For example, we have common shares and preferred shares. So when we say earnings per share, we are referring specifically to earnings per common share. And earnings, of course, refers to net income. Now, if we're talking about the net income per common share, we should be removing from net income that portion which the preferred shareholders are entitled to, which would be preferred dividends. We're going to divide this amount by the number of common shares issued and outstanding. So it sounds pretty straightforward, but there are a few things that could add some complexity. Let's take a look at the formula. So here we're looking at a formula for EPS, or earnings per share. And we can see that it is net income subtract the preferred dividends. A quick note about the preferred dividends. If the preferred shares are not cumulative, we'll deduct the dividends if they were declared. If the preferred shares are cumulative, we'll proceed as if the dividends were declared for the purposes of the earnings per share calculation. Next, what is the denominator? We are going to be dividing by the weighted average number of common shares. So as we know, the number of shares for a corporation might change throughout a period. A corporation might buy back their shares, they might issue new shares, they might have a stock dividend or a stock split. And if the number of common shares is fluctuating over the income statement period, what we need to do is use a weighted average. It's the best way to get a fair number. In order for earnings per share to truly be useful, we need to understand some of the components that are introduced with a corporate income statement. Let's take a look at an example. This is example 14-3, and the background we are given is we are told that the income statement for 14.3 Limited is presented below. Let's go through it. Like any good corporate income statement prepared in good form, we begin with the legal name of the business, and then we have the name of the statement being prepared. In this case, we are looking at the income statement. Since it's an income statement, the period of time should be next. And here it says for the year ended December 31st, 20XY. It begins with revenues, which is broken down into sales revenue and service revenues, and then we have total revenue of $700,000. And then all of the expenses we can see are listed in a single step. So we are looking at a single step income statement. The expenses include things like cost of goods sold, SG&A or selling general and administrative expenses, interest expense and income tax expense, and then we have our total expenses. Now what you're used to seeing after that is a line item that might say net income, but we don't see that here. Here it says income from continuing operations. Well, what is that? Imagine a larger business that has many different lines of business or business segments. The business might choose to dispose of or discontinue some of those segments of business, maybe because they are not profitable or they get a really good offer for a business segment and they need that cash for something else in the business. So the user needs to know which portions of net income they can use as a base for their forecasts and projections. So on a corporate income statement, we separate continuing operations, that is the operations that are expected to continue into the future, from discontinued operations. That refers to the operations that have been discontinued and will not continue in the next fiscal year. Let's take a look. So we can see that we have discontinued operations. And we have the operating income or loss, but in this case it's income, disclosed separately. And it's net of $3,000 of income tax expense. What does that mean? Well, it means that the operating income was probably $10,000. After subtracting $3,000 of income tax expense, we have a net of $7,000. Then we have a gain on sale of discontinued operations, net of $500 of income tax expense, which is $1,000. So for this business, the total income and gain from discontinued operations is $8,000. Net income for the corporation as a whole is $130,000. So how does that all relate back to earnings per share? Well, what we can do is we can have an earnings per share figure for continuing operations and a separate earnings per share figure for discontinued operations. This example should help us understand both. So let's assume on January 1st, 20XY, the corporation had 10,000 common shares issued and outstanding. On April 1st, the corporation issued 1,000 common shares. On September 1st, the corporation had a 2-for-1 stock split. There were 1,000 $1.20 cumulative preferred shares throughout the year. 2 years were in arrears. The required is for us to calculate earnings per share for 14.3 Limited. So I've set up here below earnings per share, and we're going to do a calculation for income from continuing operations, income from discontinued operations, and we can add them up to come up with an overall earnings per share figure. Just below that, we have a section for calculations, and here we have the opportunity to calculate the preferred dividends. Recall from the narrative there were 1,000 shares and the rate was $1.20. There were 2 years in arrears plus the current year. So that equals 3,600. I'll just show you again how I did that math. 1,000 shares multiplied by the $1.20 dividend multiplied by the 2 years in arrears plus the current year. It's 3,600. Remember, because these preferred shares were cumulative preferred shares, for the purpose of an earnings per share calculation, we should calculate as if dividends were declared, even though there was no indication that dividends were declared. So now we're close to being able to do the calculation for net income for continuing operations. We can take the income from continuing operations, which was 122,000, and we can subtract 3,600. We still have to take this number and divide it by the weighted average number of shares. And that's the next calculation that we can go through on the screen. From the narrative, it says that at the beginning of the year, there were 10,000 common shares issued and outstanding. And on April 1st, the corporation issued 1,000 more shares. So taking a look at this table, we have a column for the number of common shares outstanding, the months that those common shares were outstanding, how many months in total in the period, and in here we have a column for the effect of a stock split, and then we can calculate the weighted average number of shares. If we were going to use a table like this, we could say that there were 10,000 common shares issued and outstanding from the beginning of the year to April 1st. So that is January, February, and March, or 3 months, out of 12 months in the year. Then the corporation issues 1,000 more shares, bringing the total up to 11,000. And that is true until on September 1st, the corporation had a 2-for-1 stock split. So prior to that stock split, from the period of April 1st to September 1st, there were 11,000 common shares issued and outstanding. So that is the month of April, May, June, July, and August, or 5 months out of 12 months in the year. Then on September 1st, there's a 2-for-1 stock split, which means for every 1 share, there's now 2. From September to the end of the fiscal year is September, October, November, December, or 4 months out of 12 months in the year. We're just about ready to prepare the weighted average number of shares column, but there's one more thing to discuss. The effect of a stock split could seriously skew our weighted average. So what we do in accounting is we act, for the purposes of this calculation, as if the stock split was applied at the beginning of the year. We would do the same thing for a stock dividend. This prevents the stock split from giving us a skewed result, and ultimately it's all right to do because a stock split or a stock dividend does not impact the shareholder's percentage of ownership. This stock split had a 2-for-1 effect, so we can multiply this period and the next period by 2. The third period already has the stock split in the number of common shares outstanding when we went from 11,000 to 22,000. so we won't multiply it by 2 here. Let's work on the weighted average number of shares column. We can take 10,000 shares for the 3 months outstanding out of 12 months and then multiply it by the stock split factor of 2. That gives us 5,000 shares on average for that period of time over the course of the year. The weighted average for the next period, we could just drag the formula down. And then for the final period, we could take 22,000 shares, which is outstanding for 4 months out of 12 months in the year, for a total weighted average of 21,500. That's been my preferred method of calculating the weighted average number of shares, but for a simple situation like this, there's another way. Let's take a look. So down below, I'll show another way. The numbers of shares outstanding is 10,000 for the first period for 3 months out of 12 months in the year. The next period is still 11,000 outstanding for 5 months out of 12 months in the year. What we're going to do in this method is, because we know in accounting we're going to apply the effect of the stock split to everything as if it occurred at the beginning of the year, in this second method of doing this calculation, we will not apply the stock split here. We'll just keep the number as is. We know it's 4 months out of 12 months in the year. If we multiply the 10,000 for 3 months out of 12 months in the year, we get 2,500. We could drag that down and get 4,583, and I'll just do this last one here by hand. So we have a weighted average of 10,750 before applying the effect of the stock split. So we know we have a stock split that's 2 for 1. If we apply the effect of that stock split, we end up getting the same number, or 21,500. We can now take that number and use it in our weighted average number of shares, part of the calculation. So income from continuing operations can be divided by 21,500. And we get $5.51, and that is an earnings per share figure. For discontinued operations, we can take our total from discontinued operations, which was 8,000, and the preferred dividends were already subtracted from continuing operations. So there's nothing to subtract here. We can just divide this by 21,500, and we get 0.37. So the total earnings per share is $5.88. We could do a quick check to see if that's right by taking 130,000, our total net income. From that, we would subtract our preferred dividend of 3,600, and then we can take that number and divide it by 21,500, and we get $5.88. Now, in introductory accounting, we typically are focused on accounting standards for private enterprises. And under those standards, there's actually no requirement for earnings per share. But a lot of corporations might still do this calculation for themselves, and it's a calculation we should still be familiar with. So I hope you found that example to be helpful. Thanks for watching, and I'll see you next time.